You're listening to Invest in the Future by Future Africa, a live fireside chat series where we learn from interesting people doing important work globally.
I'm happy that we're here today in this forum to again have just what should be kind of a little bit of a repeat of conversations that we've had, but they've been so thought-provoking that it was abundantly clear to us that the ecosystem needed to hear sort of what's on your mind and heart, both as a representative of one of these DFIs, right? Which are three letters that are paramount to the African ecosystem, the African tech ecosystem, but probably need a little bit of demystifying. So I hope we're going to do that over the course of the conversation. I hope we're going to talk, we're going to get further insights from the vantage point of somebody who's seen literally everything in the venture capital ecosystem, who is paid to look at this stuff, whether it's a fund deck, whether it's a seed deck, a Series A deck, a pre-seed deck, who's been on all the podcasts, who's met all the key players, right? What are you seeing? What are you feeling? We should discuss that. We should hear your insights from Proparco about what it's like to work with the DFI. We should demystify it, as a lot of the members of this great audience in the Future Africa Collective are either fund managers today, aspiring fund managers, or founders. So to set the tone, that's who we're speaking to. But before we get into that, let's start with your story. And I was actually reflecting on our conversations and just conversations that we have in general. And I wanted to, with your permission, ask you to tell your story, but start with growing up. Tell us what young Babacar was like. Talk to me about growing up. Who were some of your childhood heroes, and how did that growing up experience lead you to where you're at today?
Sure. But first, let me start by just thanking you, Ore, and the whole Future Africa team for inviting me on this webinar and podcast. I mean, it's really a pleasure for me to be able to share some of the things that I've learned in the market. I wouldn't go as far as you did, saying that I've seen everything. I think I've seen many things, but there's much more to the market. So I'll share my piece of it. And I'm really glad to see that among the participants that we have today, I recognize a number of names. I see some colleagues from DFIs. I see fund managers and entrepreneurs. So I guess we also have an interesting Q&A, and they'll be able to challenge me if they disagree as well. So this should be interesting.
Wonderful.
To answer your question, I grew up in Senegal, in Dakar.
Okay.
I mean, my heroes, there's nothing very exceptional there. I used to play a lot of basketball and read a lot of books about travel. So I was really a big fan of Kobe Bryant, the basketball player from the LA Lakers, and also a big fan of, just writers like Rudyard Kipling, Victor Hugo, who were telling stories that made me travel. So I grew up in Dakar until high school. And after high school, I wanted to study abroad. So I came to France and I studied here at a school called Sciences Po. Then I went to China to continue my studies and work at the same time. So I was in Beijing and Shanghai for a year and a half, studying Mandarin, working at a think tank, working at an NGO. So, trying out different things because I had no idea what I wanted to do. Then I came back to finish my studies in Paris. And that's when I started just, working in investment banking, then financial services in the insurance space. And then I joined Proparco 4 years ago.
And when you joined Proparco, did you join to do the work that you're doing today on leading their activities in Africa?
Yes. So when I joined Proparco, I had spent 4 years at AXA, which is an insurance and asset management group, where I was working, on more like strategy, operations, digital transformation topics. And I always knew for a number of years that I wanted to be an investor. So my objective was to do investment in emerging markets, and the development finance institutions are among the most preeminent ones in Africa in particular.
Yeah.
And so when I joined Proparco, my role is the same one that it is today, is to identify opportunities to invest in companies, to invest in funds in Africa, the Middle East, and Asia that are driving a lot of impact while enabling us to have commercial rate returns. And so I've been focused on the technology sector, so startups from pre-Series A to Series B, and the financial services sector, more traditionally banking and insurance.
Very cool. For the audience that doesn't know, can you give a little bit of a high-level overview about Proparco?
Yes, this is a very good question because a lot of people don't know us very much. So Proparco is a development finance institution. So it's a very long expression to say that we're a publicly owned company. So we're owned by the French government. And so we have a public sector mandate, which is to promote economic and social development in countries around the globe. And those countries are countries that are identified as low and middle income countries by the OECD. So it's most of Latin America, Africa, the Middle East, Central, Southeast Asia. And so within that mission, we leverage different financial tools to achieve the mandate. So we do debt financing, we do equity financing, and we also provide guarantees. And so if I speak more specifically as to what Proparco does, Proparco has around 7 billion euros in assets. 75% of that is deployed into debt. So we finance banks, we finance small, medium, and large companies, and we finance infrastructure projects. On the equity side, we have around 1.5 to 2 billion euros in assets that we invest in private equity and venture capital funds on the one hand, and on the other hand, we invest in startups, companies, and infrastructure projects. And we are a minority investor, meaning that we will generally not take control of the company, but we see our role more as a growth partner, because what we're investing in is growth. We're not investing in optimization. We're really trying to invest in companies that are going to grow and become the leaders of tomorrow. So that's how we see ourselves, as a very long-term partner to companies.
Talk to me a little bit about how you partner with companies long-term. And can you give us a couple of use cases? Because I think that that's going to be really interesting for the audience here. We literally just got in a question. We're not at Q&A just yet, but feel free to drop them in the chat. But we have an entrepreneur from Togo, right, asking, like, how can we get in touch and sort of what does the process look like? Not just like, what it looks like, because I think this is what we need to demystify. If I'm being brutally honest here, right? We need to the process of unlocking this. VC in Africa is $5 billion alone as of last year, right? And now we're hearing that there's 2 billion of it sitting in Proparco. That's going to excite a lot of the fundraisers here. So can you help us kind of understand kind of like the not just the process of unlocking the capital, but then the follow-on value from Proparco at Wide beyond, the amazing Babacar that's sitting with us right now.
Yes. No, you're too kind. So the 2 billion actually is both private equity and venture capital. So it's not 2 billion for VC. But there were two questions in your question. One question is about the process of how to get funding from a DFI. And the second question is, how do we partner with the companies? So I'll start with the second one. When we identify a company that we want to invest in and partner on the long term, it means we believe in their story and we believe we have something special we can bring. There are many things that we bring that most other investors are not necessarily built to bring. I think first, Proparco as a DFI, and this also applies to the other DFIs, we're very long-term investors. We're not a fund, so we don't have a fund life, meaning that after the end of 5-6 years, we don't have to sell. I mean, we can sell our stake, but it's not compulsory, and it will depend on, whether we believe this company can still grow. So I will take one example. We invested in Bank of Africa, which is one of the biggest Pan-African banks present in 17 countries, in 1989, when it was still a very small bank in Mali. We followed on, it was not called Series A and B, but that's what it was. We followed on more than 10 times and invested in the subsidiaries they launched in DRC, France, Djibouti, and several other markets. Wow. We're still an investor today. We're at the board. And so we have partnered with them in the very long term through investments. We have also provided what we call technical assistance. So technical assistance are subsidies for specific projects within a company. So we can subsidize market study to enter into a new market. We can subsidize the implementation of climate risk management or environmental and social risk management systems or digital transformation. And so that's another thing that we can bring. In addition to that, because we're not a fund but a DFI, we have a very strong network of teams. So if I take just Africa, we have over 10 offices across the continent with teams that have clients on the debt and the equity side. So these are hundreds and hundreds of clients and thousands of contacts that we have in all these markets that we can leverage for partnerships for the companies that we invest in. So this is something that companies seek when they come to us. And last but not least, I think reputation is a key point. As a public entity, we have very high standards in terms of business integrity, in terms of governance, in terms of our expectations from our partners. So once a company has managed to go through all the hoops and all the requirements that we have, it's a stamp of approval that is appreciated by their other investors, by regulators as well, especially in regulated sectors like fintech, financial services, telecom. So I hope this answers the question about, what value we can bring to companies.
Yeah, it answers it really, really well. Actually, I'll admit I didn't know that you guys had 10 offices across the continent that were solely dedicated to connecting your clients and your partners to each other, right? You mentioned the process of jumping through hoops and high expectations. Look, it's a really important thing for any business to have accountability, especially in venture, right? But can you share a little bit more kind of insight and shed some light into what kind of that process looks like?
Yes.
Jumping through those hoops, if I can ask.
Yes, I will differentiate between startups and funds because it's not the same process.
Yeah, and we have both in the viewership here, so
yes,
provide both contexts.
So for startups, I think most entrepreneurs know what or have an idea about what commercial investors are looking for. Mm-hmm. We're looking for all the same things in that space. So we're looking for business models that are targeting a big problem with a large target addressable market with a very strong team. This is extremely important for us, not only because it makes good business sense, but also because you want a team that is going to stay together in the long term to achieve the ambition that they're selling to you. And also because of reputation risk management. You want to have a team that has the high integrity standards that you have yourself as a hedge against any potential risks that could happen tomorrow. Because there are always difficult moments in a business, and you want a team that's able to go through that. We also looking for strong business models. So for startups, it doesn't mean that we only invest in profitable startups, but we want to see positive unit economics. We want to see a team that is not just striving for growth, but that is striving to build a sustainable business with sustainable relationship with customers. So not over subsidizing growth just to get people on board, and trying to build a moat or barriers to entry and a competitive edge. So I would say on the commercial side for direct investments, that's what we look for. The other things that we look for that maybe not all investors are going to ask. First thing, in terms of impact, we need to see that this business, if you look at the core business, that there is an impact. So impact can come in many different ways. I'll give an example of a company that we invested in very recently. It's called Go My Code. So Go My Code is a Tunisian education technology company that's present in 8 African markets. What they do is they train young people in IT skills. So it can be web development, digital marketing, or other related fields. And they give them skills that enable them to find jobs. What really impressed us in that company were 2 or 3 things. First, very strong founding team. So the founder launched the business when he was 18. He's now 23, grown into several million euros in revenue with a good management team. Business model that's highly scalable. Why? Because they have a hybrid teaching model where part of the classes are online, part are on site. So lower cost base, meaning that they can be profitable much faster. And third, the majority of their students actually find jobs. And it was often people who didn't have jobs before. So people who had an engineering degree and were unemployed, they come and they do the Go My Code training, and then they find a job as a web developer. And so that's where we see the impact, because this is a business that's doing something that's useful to society and that has a model that enables it to do it at scale. So this is something that we're looking for on the impact side. The other things that we will look at are what we call ESG, so environmental, social, and governance. On the environmental side, it's maybe a bit less relevant in the tech space, but we would look at potential negative environmental impact of a business and ensure that it is well mitigated. On the social side, we would want to see the business is managing that part, meaning that it's treating properly its employees, suppliers, and customers, and not excessively playing against competition or colluding with other partners to distort competition. So that's important. And governance is just general good governance principles. And finally, I would say one aspect that's important to us is what is called KYC, so know your customer, and anti-money laundering. Especially in the financial services space, we're very careful that all the businesses that we partner with are businesses that have a certain level of standards in this space. For example, if you take a payments business, you would want the company to be filtering against terrorism lists so that sanctioned people cannot transact and do the same for lending business. So these are some of the differences that we would have with a traditional venture investor for direct deals. So I'll pause here and see if you have any questions, and then I'll move to the fund side.
I do have 2, if I may. At least that come to mind. You say something really interesting about you're looking for teams that are going to stay together for the long haul, right? Teams that are really dedicated, where there's not going to be a lot of turnover. And then you get into to ESG, right? Specifically the S side of it, right? The treating people well. How do you measure that? And how do you evaluate that? It's very interesting. You as Proparco, and also, you as a person that's been put in this position, given this incredibly fulfilling responsibility to lead Proparco's investments. That's a tough thing to measure, but I'm very curious just to hear kind of how you do that, and how founders, and I guess in this case we're still talking about founders, right? We haven't gotten to funds yet. How founders should be prepared to have those conversations with you in a manner that's authentic and genuine, right? Because
I guess
we're married, but they might not be, right? So
I guess for the team side, to be honest, I think any VC is going to look for the same. We don't ask that necessarily all the team is going to stay forever, but we want to have a very core team, or the founder or the 2 founders that are really committed to the business. You're taking a lot of risk investing in an early stage business. So you would want the founders to, have skin in the game and really be committed, and so that it's not a quick buck project, but that they're really trying to build something. And we're not there to do it instead of them. We're there to help them realize the vision that they have. And so it's really important that they're committed. On the ESG side, it's pretty straightforward and not straightforward at the same time. So,
are there checklists, right? Are there
exactly
secret algorithms behind the scenes you can?
No, there's nothing secret. Actually, in ESG, if you want to know everything, you just have to go to the standards that have been, published and publicized by the International Finance Corporation, which is the development finance arm of the World Bank. And those are the standards that all of the DFIs work on. So we have our own standards, but the common framework is the one of the IFC. So if you look at the IFC, it's called IFC Performance Standards. They have those for almost every sector, and they will give you an idea of what is expected that companies respect. So if you take financial sector like microfinance or lending or savings, it will be around consumer protection, ensuring the customer data is protected, that they have access to the right information before they take a loan, the rates are not excessively high, and so on. So it's things like that. It seems pretty straightforward. And then we have one thing which is specific to every DFI, but again, taking the same foundation, it's called an exclusion list. So those are all the sectors that we cannot invest in. So it's sectors like gambling and vice in general, weapons and things like that.
Yeah. Okay. Over to funds. Speak to the fund managers here.
Yes.
Like ourselves.
Yeah. No, it's an interesting the conversation, because maybe there's much less information about how to raise a fund in Africa online. So I'm really happy to be sharing, the bits that I've collected. Right. So first, I would start by saying that if you look at the African funds market, and when I say funds, I mean private equity, private debt, and venture capital, most of the funds in the market, excluding South Africa and to a certain extent Egypt, are funded by DFIs, so development finance institutions. It's very rare that you see an institutional fund that has raised more than one fund with more than, let's say, 50 or 100 million that does not have DFIs representing over 50% or 2/3 of its capitalization table. So this is the first thing I should say, is that Africa is the exception in global markets in terms of where long-term equity funding is coming from. So I think it's important to start with this. So this means that in Africa, DFIs have an outsized role in kind of driving trends of what are the strategies that are going to get funded and who's going to get funding or not. So for instance, one of the results of this is that in Africa, private equity and venture capital has a much stronger ESG framework than what you would have in Europe or the US as of today. So ESG is becoming big in Europe and the US now, so they're investing a lot and developing a lot of tools that are now catching up and maybe going further than what we do. But Africa had it in its DNA in a way. So that's the first thing I wanted to say. Once you've said that, you want to take a step back and look at where we come from. Before the 2000s, you had very few PE and VC funds on the continent. So I would say that 2000 to 2020 was kind of the private equity era. So it was the era when PE emerged on the continent. You had a lot of funds got raised and institutional players get established like Helios, like DPI, like ECP. And over the past few years, you've had, VC really becoming the new beacon, with now even PE funds coming into VC because they see this as the big new market in alternative asset management. And so what can we learn from that? Fundamentally, it's again what I was saying is that over the past few years, DFIs have been structuring venture capital programs that give a big space to fund financing. And so this has given a lot of opportunity for funds to get created. And so I think that now we're in just the first phase of this, where a lot of new players emerge because DFIs are giving their chance to a lot of first-time managers. In a few years, probably there will be maybe a bit less opportunities for first-time managers, as the LPs are going to focus on the players that are maybe a bit more established. So how do you raise money from a DFI? I mean, there's no secret sauce. I guess I'm maybe not the best placed to tell you how to do that. You should probably ask the people who have done it. They will maybe tell a different story from what I'm saying. But
decision maker, right?
Yeah. But from the LP perspective, the things that are really important to us, first is team. Team is paramount for a fund. It's even more important than for a startup. Yeah. Why? Because, startup, you have a business. Once you're Series B, Series C, the business exists. If you remove the founders, it can still run and there's something. If you take a fund, it's a relationship business that mostly relies on people. And it's being invested in companies that you don't know at the moment when you commit the money. So I'm, giving you money that you're going to manage for me with a blind pool of capital. So we set very high level guidelines for the investment strategy. And then, you have the money for 10 or 12 years, and I don't know what you're going to do with it. So I need to be really sure that this team, knows what they're doing, is going to stick together, and is going to do what they promised they would do. So first thing is really ensuring that you have a team that knows each other well, a team that has the ability to deliver on the strategy that they're selling. So if someone is selling you on a venture capital strategy, you're going to do a lot of due diligence to make sure that they understand the startup world and venture capital, that they have a good reputation in this sector, that they are appreciated by other founders and other investors, and essentially that they're going to be able to be a relevant player in the market. And so that's what the team aspect is going to give you. Yeah, I cannot put enough emphasis on this one because it drives almost everything. Why also team is so important? Because raising a fund is not like raising a round for a company. Because of this blind pool approach, it takes a lot of time for general partners, so the ones that are raising the fund, that are managing it, to build a relationship with the limited partners. And this is one part, we've discussed it, Caleb, but that most GPs maybe underestimate in the beginning how much time is going to take, because you need to build almost personal relationships with the people at the different funds, so that they get to know you, they get to really understand your strategy, meet the companies that you're already invested in or are planning to invest in, and basically build a trusting relationship. Because if I explain something that's, what's happening on our side, all DFIs are understaffed. Okay, this is notorious.
It must be sensitive to you.
Yeah, so we have a very small team.
Everybody.
So yeah, we have very small teams compared to the objectives. So we need to prioritize a lot all the time. So once we start working on a fund project, the likelihood that we're going to invest in that fund is 95%. I've rarely seen DFIs that go on due diligence on a fund and then don't make the investment, because generally you build a conviction before. So that's why the threshold is really high. And so that's where the team is really important. So first step is team. Second, of course, is strategy. What is important in in the strategy. And by strategy, I mean both investment strategy and, kind of the setup. Investment strategy, well, you need to be convinced that this strategy makes sense. Makes sense from a financial perspective, that this is a strategy that can bring returns. And so the GP needs to be able to explain it and substantiate it well. You need to believe also that this is a strategy that has a future. So, if one sector that has worked a lot in the past 20 years is investing in telecom towers in Africa. Maybe a lot of people have made a lot of money investing in that, but do you believe that there is still a lot of growth in that sector in the next 5 to 10 years? It's not because you had a great track record in one sector 10 years ago that it's relevant now. So the relevance of the investment strategy to the current trends is something that we check. And third thing that we check is the strategy big enough? This is something that, we've seen with a number of funds. Sometimes the strategy is too narrow, saying you're doing maybe just one sector or you just want to do this one geography. Sometimes it makes it more difficult for LPs to look at those strategies because less risk diversification, and also maybe we don't believe there's enough pipeline for you to build a good portfolio. So it's important to keep those things in mind, that you also have to address some of the LP needs in that strategy. And I mentioned the second part to the strategy, which is setup. By setup, I mean the team, of the fund and how you see the team of the fund. So if I have a fund that says, I'm going to do Pan-African fintech, and I have a team of, I'm exaggerating, but I have a team of one, I'm going to be first very challenged to believe that you will effectively be able to do that properly because your team is understaffed. Or if I have a fund that's telling me I'm going to have a huge value add, I will help founders with hiring, I will help them with strategy, with operations, but you only have a team of people who have maybe investment banking or transaction background, and none of them have ever worked in a startup or a business. So how are they going to be bringing that strategic expertise to the founders? So, the setup really needs to match with the strategy to make it more convincing and appealing. And I think one other thing, of course, that's important is track record. So by track record, what LPs mean is, have you made investments in this space that you want to raise a fund in? And even better, have you made exits? So that's important. And you don't necessarily, at least at the stage where we are in VC in Africa, you don't need to have like 10 exits to raise a fund, because we all know that VC in Africa is a very new space. So the standard is a bit lower than what you would have if you were raising a VC fund in Europe, where there has been a market for 30 years. So if you have never made exits, probably means you don't know how to make an exit. But we would be looking at the quality of the businesses that you have backed, how well they have fared since you invested. We would be speaking to those portfolio company founders, asking them, what was the relationship like with these guys? Where did they help you? Were there any challenges? And yeah, I guess for track record, that's what we would look at.
Anything else about that the fund managers here and the aspiring fund managers?
Last thing terms.
Before I get into a couple other questions.
Yeah, last thing is economics. The economics need to work. What are the economics is the things that gets debated the most when we make an investment. Is what is the level of the management fees? What are the terms around the carried interest? What's the size of the team compared to the management fees? If you're paying high management fees and you have a small team, it creates a disalignment of interest.
Trying to get their cut.
Exactly. And finally, GP commitment. So how much is the team putting its own money into the fund? This is skin in the game. So this is money they're going to lose if the fund underperforms. So it shows also that they believe in this strategy. So these are the things we look at, and it goes together with the budget. It's very difficult to come and say, I'm raising a $25 million fund, and to want to have a big team, because you will have either very high management fees, which makes it less attractive to the investors, or you will have standard fees, but your team will be too small, or the salaries will be really low. And so when the salaries are low, one thing that we will wonder is, are you able to retain your teams? And we've seen funds that had that challenge where, maybe they're a bit subsized, and the result is they cannot have the proper setup for the strategy they want. And so they're challenged to retain the team. Sometimes you have departures, because even if people are passionate about what they do, at some point, everybody has constraints. Yeah.
I love what I'm hearing here from you, that it's all about team at the end of the day. And it's all about those relationships, right? Because we hear what we hear about DFIs, right? Like, I'll be honest, there's sometimes a stigma in the ecosystem that it's a little bit difficult to work with, or, there's too many DFIs and there's too much DFI capital. Maybe we need to diversify a little bit, right? This isn't my words. This is the words of the ecosystem, but it's very moving and exciting, especially from a Kobe Bryant fan, a fan of the greatest team of all time, the Lakers. And he's also a hero of mine. So I'm feeling a great connection on that. And I like that you do approach it with the Mamba mentality and the diligence with which you should, but also with kind of the reality, which it's about team at the end of the day. A question that I wanted to just ask to conclude. I'm very fortunate that we're friends, because I'll ping you with several more after this, and the audience will too, but I want to give them the opportunity to ask, and questions are coming in. But let's take off the Proparco hat for a second, right? And ask you, like, what are you seeing? What excites you? Where are we headed, right? Your childhood is in Senegal, right? So this work is obviously much more about, this work must be deeper for you than just, checking off the criteria of the government mandate, right? I imagine it is, at least. And forgive me if I'm being a little bit less diplomatic about my approach to this question, but take off the Proparco hat and tell us what you think. Tell us what you feel. What's on your mind and heart as it relates to this really special ecosystem that we're building together. And as you've mentioned, you've been so instrumental in that. Your institutions and your industry, the CFI industry. What's on your mind and heart as it relates to the VC in Africa ecosystem?
Yeah.
Tech ecosystem, before we get into some questions from the audience.
Yes. I think, to do this job at a DFI, you have to be passionate. And I have to say, I'm really lucky that I have a lot of passionate colleagues, not just at Proparco, but also at FMO, BII, IFC, and all the other colleagues that we work with in other development finance institutions. So, we all hold this really dear. I think for myself, even like you said, I grew up in Senegal. This to me has also an additional meaning that, venture capital is about creating new companies, and backing those companies, helping them getting built. The way I see this is VC, if you compare it to PE, it's a sector that has the potential to create the millions of jobs that Africa needs and to solve problems that we've had on the continent for a while with new approaches. And you see it in a number of sectors. I mean, take logistics, fintech, payments, education. Technology and also the innovation mindset that we have within the VC community is bringing things that we didn't have in the traditional economy. And I think this is our role. Our role is to find the fund managers that have this mindset and that are going to be able to find the companies that are solving the big problems in a bold way, in a new approach, and help them build those businesses. And so we will back those funds, and we will ourselves also back companies that do that. So Now you ask me to remove the Proparco hat and say, take my oracle ball and read the future. So I don't know what's going to happen tomorrow. However, what I believe in, and I've thought a lot about this. I think the market for entrepreneurship and startup funding in Africa is just at its beginning. African founders have been so starved of funding and people giving them trust to build bold things, and people giving them resources, not just money, but also advice, relationships, partnerships, corporates accepting to work with them, that there is this latent energy that is really huge in all sectors. And I think we're just at the beginning, because you see every day new companies that are getting built that address bigger problems or existing problems with much more innovative solutions. And so I think that if VC is now a few billion, maybe in 5 to 10 years it's going to be 3 to 4 times bigger. And I think what is going to be interesting is when we see founders that have built companies to scale. As of today, most of the startups that are most famous on the continent, they're still, tens of millions. A few of them have reached hundreds of millions in revenue and several hundred or thousand employees. I think once we have startups that become maybe not conglomerates, but Pan-African groups with thousands and thousands of employees across the continent, that those startup founders engage directly with governments to help them drive policy in specific sectors, engage and challenge the big, old economy competitors. That's where we're going to see even more innovation come into the market. And so, I'm not teaching you anything. I'm just saying that I think this is just the beginning. It's going to get bigger, but it's really important, if we want to get there, that we build a virtuous ecosystem. And we have a big responsibility in this DFIs, ensuring that we back the best funds, the ones that are really adding a differentiated value proposition to the market. Ones that have a very strong alignment of interest with their limited partners. Something that has happened in the private equity space, and I refer to it again because we need to learn from maybe past mistakes, is that in the private equity space, a lot of people got rich from management fees and never earned carried interest. We don't want that to happen in the venture capital space. And this is really important, because carried interest is, for people who don't know, is the profit that a fund manager is going to earn if his investments perform really well.
Right, it's success fee, basically.
So it's supposed to be, it's the success fee, it's the upside. So if you have a virtuous ecosystem, people will make a decent salary from the management fees, but the bigger part of the reward will be in the carried interest. If it's not done properly, it's going to be the reverse. And we really need to be sure that we get this right. And secondly, fund managers have a responsibility to back businesses that have responsible practices. I just say it as a general term, but we've seen in other markets in the US, tech companies that have very negative effect on democracy, very negative effect on society, on business, and that even though they got big, are probably reducing, social value in the market. We also need to be mindful of that. We're a market where governments are rather weak. Even if you have regulation, they're not able to enforce them. So it's also upon the business community to build, let's say, responsible practices. So those are the two things I think are the big risks that could make this a failure.
This is such a powerful message that I'm going to wrestle with long after this conversation is, or long after this chapter of the conversation, I should say, is over, which is we need to build a virtuous ecosystem. Thank you. Thank you for that message. It rings so true, not just within Future Africa and our collective, but there's just there's so much truth in that. And we should pursue that with a Mamba mentality of excellence, of building that virtuous ecosystem. So thank you truly for mentioning that. I'm going to go to some audience questions, and some of them are interpreted from questions we've seen in the chat. Some of them are direct, but the first question that I'm sure everybody here would crush me if I didn't ask you is how to get on your radar and how to get in touch with you if they want to, think about, given everything that you've said, right? Like, do you reach out to them? Do they cold email you? Do they need a warm introduction? Be honest. You said you're very understaffed, and we're super grateful for your time. But
no, there are different ways to get in touch with us. I mean, warm introductions always work. I think we have backed businesses that cold emailed us as well. It doesn't really matter where it comes from. I mean, if it comes from a trusted source, it's always helpful because, like every investors, we receive a lot of proposals, and so we prioritize them. But I mean, reaching out on LinkedIn, we also very present at a lot of conferences and events, so you can always meet us there. That's how we met Caleb. So yeah, I mean, just reach out. I think the only important thing that I would mention is, especially for startups and funds, if you're reaching out to an investor, send a deck. If you don't have an introduction from someone who knows them, because we would want to look at that before we engage, a more, formal conversation.
Interesting. It's a challenge though, sometimes, to be honest, to send the deck before the conversation.
Yeah.
Right? Sometimes the relationship is, you miss those opportunities when you just see it based on the deck. A couple of questions that came in. So the question here is, do you invest in environmentally sustainable focused businesses focused on tackling the climate crisis and climate change that we're in? And can you give a couple of examples of those businesses?
Yes, we do. Actually, we have a small fund that we manage, which is focused on clean tech in Africa. So we did a few investments from that fund. Actually, interestingly, it was just announced that we exited one of those investments. We were an investor in Daystar.
We just exited yesterday.
Exactly. We sold it to Shell. So we invest a lot in mini-grid and off-grid solutions, but we're also looking at, clean water, waste management across the continent.
Okay, cool. Congratulations on the exit. Hopefully that will
Thanks.
Like more businesses. Were you guys involved in that exit process, or just kind of supporting it?
Yeah, more supporting it. We were not the lead investor.
Okay. Can you talk about some of the riskiest businesses you've invested in, and were they successes and failures? And
riskiest.
And how did some of the failures impact your decisions? I mean, I heard what you said about private equity, which is such a powerful point to fund managers, right? The idea of not being greedy on management fees and focusing more on carry. But can you talk about some of your more risky bets, what those look like? Not bets, don't do gaming, but yeah.
It's difficult to say what is a risky bet, what is the riskiest bet, because every time we make an investment, we will identify the risks and try to mitigate them. So I mean, the perception can be that it's a very risky investment, but we have a conviction that it is not. So I'll take an example. Last year, and this is not in the tech space, it's in the banking space. We invested in a bank in Palestine. So, most people would say, well, this is really risky. Who invests in Palestine, basically? But we saw a strong business with good fundamentals, a great team, and visionary management that's able to deliver. And we invested, and it's going well. If you look at it from outside, you'd say this is very risky. We looked at it from the inside. we figured it's not as risky as it looks.
Mm.
And we've invested in geographies like Iraq. We invest in Lebanon. I guess, yeah, you can say Lebanon. I mean, if I stay in the same geography,
Of course.
didn't seem very
You're
risky.
investing in all of my neighbors. Thank you.
Yeah. So Lebanon didn't seem risky 5 to 10 years ago. Well, it happened to be one of the riskiest markets when the macro situation got disrupted. So I guess no one has a crystal ball. We just try to manage the risks that we see. And, when we learn that some risks are maybe more material than we thought when we made the investment, then we adjust our framework of analysis. So I think that's how I would see it.
Cool. I have two more questions, quick ones before we wrap up. One is maybe a little bit longer. It's a good question here. Can you tell us a little bit more about the incentives of the individual players on the DFI teams and how they are aligned with the portfolio, both startups and funds?
So this depends on each DFI. But
yours, then.
Yeah, we don't have incentives related to the portfolio. DFIs are public institutions, so generally people are not incentivized on their underlying performance. So there's no carried interest or bonus based on the performance of the investments. And that's why I think when they hire people, a very important criteria is how passionate people are about what we do. This is probably, together with the investment skills, the two most important things that we look for in people. So the incentive is more in the, how rewarding the work is. And I have to say, we have great work cultures at Proparco and the other DFI. So it's a lot of fun. So, if anyone's hearing me and thinking about joining us, I can confirm that you will not have a boring day.
Nobody on the Future Africa team is hearing that. We're all very happy here as well. We have a great culture. So that's so good to hear, and I'm so happy, and I don't just see that and hear that. I feel that every time we get the chance to talk. But I feel like each time we get to know each other a little bit personally. And the question I wanted to conclude with before I kick it over to Ori to wrap us up is a question about your favorite books. I heard you're a basketball fan and got really excited, but then somebody else heard, thank God, that you're also an avid reader. Can you talk to us about some of your favorite books that you've read, past and present, and maybe some of the ones that are on your bedside table that you're waiting to read, if you get time after reading all of our decks?
Yeah. I mean, you have to read books. It brings you other perspectives. Yeah, I'll start with one book that I think is also very relevant to this conversation. It's called The Prosperity Paradox. It's written by Clayton Christensen and Efosa Ojomo and Karen
Send that to everybody.
Everyone has to read that book if you're interested in investing in Africa.
Yes.
So it's a book that talks about how creating businesses and creating new markets is actually the best way to generate prosperity, rather than, focusing on fighting corruption. So to put it very simply. And so by creating businesses and innovating in new markets, we can build a better Africa. So I'll summarize it like that. I think that book is very powerful and very inspiring as well. So that's one book. I don't know.
Yeah, pull it off your shelf. It doesn't have to be a business book, by the way. It can be a novel.
But I read a lot of business books, actually.
Okay.
Sorry.
Or philosophy or...
Yeah. I mean, a non-business book that I really like. I mean, there are many. I mean, any book by Émile Zola, he's a French author, is great. It's books about France, social issues. So yeah, not very close to our conversation today, but those are really interesting and well written.
We'll save it for another time. I apologize that we weren't able to get to all the questions from the audience. There were many. This is a really fascinating topic. We will find a way to get to them or do the best that we can. we'll save them, and whatever we can answer through subsequent social media chats and Twitter and LinkedIn or via email. We're here. We can be reached at investors@future.africa. Our handle on all of our platforms on our side is @AnAfricanFuture. Babacar Seck will tag you so that people can reach out to you as well if we want, and continue this really engaging conversation. Babacar, thank you so much for your time. If there's any final message that you want to share, the floor is yours. Otherwise, I can't wait to ball with you again soon, my brother.
Yeah, I guess I have one last message. I know a lot of people think DFIs are just very opaque and difficult to reach. I think, it's our job also to come and share, how we work, but you should never hesitate to come to us. And I would highly recommend all the forums where DFI are in attendance, like the Africa Venture Capital Association, the AFSIC in London, and the VC for Africa and other programs like that. Because once you get to meet the people in person, you will have a much more precise understanding of what we're looking for. Always, when you get rejected, try to get feedback, even informally, from the people who were your contact points at the DFIs. I find that is quite helpful when people know why they didn't make it, because sometimes it's not that big of an issue and it's something that can be addressed. And in the end, we all want this to work. So yeah, that's my last word. So thanks a lot, Caleb.
Thank you for listening to this episode of Invest in the Future. You can follow us on all our social media platforms @AnAfricanFuture to get more insights into the African tech ecosystem.